spends. For example, if I bring my children go to last Christmas, I brought my family to Orlando for vacation. So all the costs can I deduct? The answer is yes, because in Orlando I prospect people, I talk to people about the business, right? So I can legally deduct my portion of the cost. But without business, we cannot. So gross income minus qualified deduction minus business cost equal to AGI, adjusted gross income. AGI is a very important concept that will determine lots of things in the future. So after AGI, the next step is standard deduction, either standard deduction or itemized deduction. Which one is better, higher, go with that one. And the other one is qualified business deduction, if you have business. Use me as example, 20% of my business income, no tax. So that's why in the United States, having a business is I would say the biggest thing for tax saving. So after that, the money we get is taxable income, meaning that income we should pay tax on. Now then, next step is apply tax rate. That will calculate how much tax we need to pay in a year. Let's use 2024 as example. If you apply this one, tentative tax is the income we got to pay to IRS. Now next, when you have W-2 income, every paycheck you will see tax withholding. That means your company already withhold portion of your income for the tax. And if you have children, like Maxwell, right, you have more. So there are some tax credit. So tentative tax minus withholding minus tax rate equal to some number. If the number is positive means then you need to pay more. But if the number is negative, meaning withholding too much, then the tax you need to pay. That means they'll refund you. So sometimes people say, hey, look, this year I get a refund. I feel happy, right? But that only means you pay too much. You let IRS use the money free. Okay? So this is basically understand how tax works in the United States. So let's look at the 2024 tax brackets. Let's use marriage joint filing as example, right? Depends on your income. So the taxable income is not just one tax rate. It's just step by step. So first 23,200, 10% tax. So if you make this amount, then tax will be $2,320. And then the next step, 23,201 to 94,300, pay 12%. So there are total 7 tax brackets. The highest tax rate is 37. So majority of people, I would say, is within 22% to 24%, this category. Now, there's another system. So you may have heard about AMT, alternative minimum tax rate. So basically, the system calculates 2 types of tax we got to pay. This on the left side is a regular income tax bracket according to these different brackets. And the other one, they also calculate alternative minimum tax rate. Whichever is higher, we got to pay that one. So if you hit this ATM tax rate, there are only 2 tax brackets, 26% and 28%. So this AMT start 1969. That's mainly for the rich people at that time. But because inflation, because middle class, the family make more, for us, it's easily we will hit this tax rate. Okay. Now, let's look at this is how 1040 form looks like. So most of the time, people don't even look at this form because they use TurboTax. software or CPA do it. This is how look like. You have income, how much you make, all type of gross income put in, minus adjustment and then deduction, and this is how much tax we got to pay. And withholding and credit minus withholding already, and this is even we get refund or we need to pay more. Okay. Now let's get some exercise about how to determine how much tax we're going to pay, what is the marginal tax rate versus effective tax rate. Maxwell, do you know, have you heard about marginal tax rate versus effective tax rate before?
Well, I've heard it, but number one, I don't know what it is. And number two, it doesn't even bother me anyway.
Okay, so it's important. These two concepts is very important. Okay, let's go through by one. For example, this family make $250,000, $250,000 income. This is gross income. Then let's assume this family only make 10,000 401k contribution. Now, how much will be the adjusted gross income? Gross income minus contribution, 240,000 will be the AGI. And this concept is very important. And then minus, before 2018, yes, we do have personal exemption, but after tax cut, reform, no more. But next year, supposedly, this will be back. So next, back to you, more kids. If next year, 2026, this come back this one, that will be better for you. But right now, not yet, I would say, okay? Now, then deduction. Remember, we do have standard deduction and itemized deduction. Use this family example, state local property tax paid $10,000. And mortgage interest paid $20,000, so altogether $30,000, right? But standard deduction, 2024, maximum is $29,200. Which one will be better for this family? Itemized deduction or standard deduction? Will be itemized deduction, because itemized deduction will be $30,000, but the standard only $29,200. So they will go with this one. And how much will be taxable income? $210,000. That will be taxable income. Now, then go to step by step. First, $23,200 will be 10%. Now, step by step, right? In this family, what will be the marginal tax rate? Marginal tax rate means the maximum tax rate this family need to pay. In this case, marginal tax rate is 24, right? Now, what is the effective tax rate? Effective tax rate basically means the total tax this family paid divided by the taxable income. Now clear, right? Now the reason why marginal tax rate is important is because, let's say if you invest stock, for example, you buy stock, hold it less than 12 months, you sell it, and you make, let's say you make $10,000. This $10,000, how much tax you got to pay? Because you sold the stock within 12 months, you got to pay short-term capital gain tax. Now, what is the short-term capital gain tax? Marginal tax rate will be the short-term capital gain tax. So even you make $10,000 from stock markets, you got to pay 24 of 10,000, which means $2,400 you got to pay tax. So that's why marginal tax rate is important. Okay, I know there are so many numbers, but just understand marginal tax rate means the highest tax rate the family need to pay. Now, so that's why tax planning is very important. So there are two different types of tax saving strategies. The first one, when we make money, we bring money home, we got to save tax. Do you agree? So what tools do you have? Majority are the retirement account contribution. So you make income, you save some money in a retirement account. That will help you reduce tax. Then besides these accounts, what else? Having your own business is another way to save tax on your income. For me, to be honest, because I have business, right? So that helped me reduce my tax quite a lot. And because the government encourages people to have business. Because when you have business, maybe you can provide job opportunities, right? You hire people who help the family, the society. Now, this strategy for that money come home from their side. The other one we got to think about is, if we want to make money work for us, for the gain, we also want to save tax. Do you agree? So what else you have? Maybe people are familiar with Roth IRA or Roth 401k. Company offer this to you. What else do we have? Do you know Nicholas and Wilson? I mean, sorry, Maxwell.
I'll take that name too. So, depends on where you work. So they have this, I think, HSA and other thing.
Yeah, HSA, yes. Yeah. TSP, that's for retirement too. Yeah. So, very good. So, these are all the all the accounts that people can leverage to save tax. So, on the left side, right, this account for the contribution help you to reduce tax the year. So, before April 15, what else you can leverage is, if you are qualified, you can save $7,000 to your individual retirement accounts. But if you are 50 plus, you can have more, 1,000 more contribution. Yes?
That tax in 401ks and the IRAs and stuff, I didn't know you pay tax somewhere along the line. You still got to pay.
Exactly true. Yes. So all these accounts on the left side help us to reduce tax now, but we will pay in the future. Okay. So before April 15, the only option we have for 2024 tax saving strategy, either individual retirement account or SEP IRA, or if you have defined benefit plan, you can have $275,000. You don't pay tax. And you just mentioned HSA account. Yes, before April 15, if your health insurance is high deductible health insurance, family can save up to $8,300. Tax-free growth. When you use money in the future for medical expense, no tax. Okay. So these accounts are good for tax now. On the right side, this account will not help us to save tax now, but going forward, no more tax. Roth IRA, people may have it, right? But there's an income limitation. If people make too much, like 2024, if AGI is more than $240,000, people cannot save Roth. Okay? And if company offer Roth 401k or 403b, yeah, we can contribute up to $23,000. If 50 plus, catch up $7,500. So it's either or. Right? 529 is for education only. So last year, if you come to my seminar about college planning, I don't recommend 529 because it will reduce our chance to get a financial aid. And the other one is under 7702. This account, as you can see, is very flexible. There's no limitation in terms of this, how much people can put. So if you look at this one, this is something related with tax planning. Now, question is, where should we save our money? There are only 3 places. Tax yearly meaning for the gain, we got to pay tax every year. So the money we save in the bank. If you invest in the stock market, or mutual fund, or rental house, every year if you make money, you got to pay tax. Right? But remember, the investment we put in, we already pay tax already after tax money. Whenever you have gain, for example, you save money in a bank, you receive limited interest. Do you need to pay tax? You got to, right? End of the year, they give you a 1099 form. You got to pay tax. And you pay tax this year for the gain. How about next year? Every year, as long as you have a gain, you got to pay tax. Now, second one, you don't pay tax now, but you pay tax in the future, later. Meaning our retirement accounts. Right side, you pay tax now, but in the future, no more tax. Where should we save our money? Tax later, tax free, or tax yearly?
For me, I would say tax later.
Tax later, right? You save tax now, but you pay tax in the future. Okay. Why you feel this is good? Max, yeah. Yeah, you can.
Yeah. Because money has value.
Yes, yes.
So, as inflation and other things affect the value of money, let me see if I'm making it right. Suppose I have money to buy. Suppose this was a house,
Yeah, yeah.
and I have the money to even buy it outright.
Yes.
It won't make any financial sense to pay it now because of the value of money. So I would like to spread it over a period of time.
Yeah, defer in the future. Yeah, yeah.
The value of money tends to appreciate.
Yeah. Okay. Okay. Yeah. That's most of the time people feel like, okay, I don't pay tax. Then money grow, tax defer. Right? In the future, I pay tax. One thing we got to remember: tax rate. Do you feel currently tax rate is higher, or future tax rate will be higher? Then, if you know future tax rate you pay is lower than now, meaning if you save in a tax later, meaning you can save tax at a higher rate, but in the future you pay lower rate. Yes, tax later. But if you know future tax rate is higher than now, for example, then it should be here, right, tax free, because you pay lower rate. The future, if they increase tax rate high, you don't worry. But what will be the future tax rate? Now let's look at this. In the United States, tax rate is determined by debt. You see, this gray area is the debt to GDP ratio. Now, the red line is the marginal tax rate. Remember, marginal tax rate means the highest tax rate. As you can see, during World War II, the debt to GDP ratio is 119%. So during World War II, the highest tax rate is 94%. Right? As you can see, after World War II, debt going down, tax also going down too. But interesting, you can see late 80s, early 90s, there's a crossover. You see, debt going up, tax continue to going down. Supposedly, if the debt is going up, supposedly tax going up. Do you agree? But this does not happen in late 80s, early 90s. The reason is because baby boomer generation, those 76 million people who was born after World War II from 1946 to 1964, they all go to work. So even tax rate is low, but so many people work. Government can still generate enough tax. But what's happening to baby boomer now? They are retiring. So it means less people work. when they retire, it is time for them to claim Social Security benefits, Medicare benefits, because when they work, they make a contribution. Of course, right now it's time for them to claim. So let's say, what is your expectation in the future tax rate? Will be high or be low? As you see right now, I just get this number from yesterday, 133%. That is 133% as of the GDP. And right now, everybody will feel that we pay too much tax, correct? But in reality, the tax rate is only, marginal tax rate 37%. It's at a historical low already. But we still feel we pay too much tax. But how about future? Do you feel future tax rate will continue to going down or going up?
I think it will go up.
You think, right?
Yeah.
Yeah, I agree with you. It's very likely going up, right? It's very likely going up. Now, back to your question, where should you want to save? At least diversify, right? Put some money here. But in reality, where people save most? Here. Do you agree? So that's why tax planning is very important. We got to diversify. We should not put all eggs in one basket, should we? But look at yourself, or most of us, or our friends, where they save. They save here. And this is the challenge, this is the issue, right? So we got to reallocate to here. Roth, but Roth contribution maximum is $7,000. But if you want to put more, sorry, they don't allow you to do so, unless you are 50 plus, 1,000 more. And 529, it will impact financial aid for college. It's a very expensive college cost. So try not to save here. And the other alternative, 7702. Okay, so this is the powerful thing about tax planning. That's what we do. Okay, so we got to control our tax brackets, right? So let's use this example. This is just pure math. For example, in the future, only 3 tax brackets, 15%, 25%, 30%. Let's assume this family need to get $150,000 for the living cost. Remember, this $150,000 would be after tax money. So in order for this family to get $150,000 after tax money, how much they got to take? If this family only have 401k, remember 401k contribution is tax deductible, but when they take money out, you got to pay tax. If this family only have 401k or IRA account, in order for them to take after tax money $150,000, this family need to take $195,000. How much tax this family pay? $45,000 a year, every year. Now, if this family have tax planning doing well, has diversified assets, what this family can do is take $80,000 from 401k, which pay about 15% tax, lowest tax rate they pay. Now, up that, another $85,000 they take from Roth IRA or 7702. Remember, we don't pay tax. So after tax money, also $150,000. But this family only need to pay $15,000 tax. Remember, the difference is $30,000 every year. So right now, because longevity, people live even after retirement, maybe 30, 40 years. If it is 30 years, this family may save about $1 million. Can you see the power of tax planning? Is it easy to make $1 million? It is not easy at all, right? But if we have good tax planning, we have more. Do you want to try this? So it's not hard. Just we know it and we can leverage. We make $1 million more. So the other day, I do have a conversation with my partner, and we do, as you may observe, in the United States, inequality is getting bigger and bigger. We know rich get richer, poor may get poor, but middle class family easier going down. Do you know the reason? One of the reasons is because leverage of financial tool. For rich people, they can leverage the financial tool, paying less tax, they're going up. But for middle class family, most of us, we go to work only, right? And we bring money home. The money sleep in the bank. Middle class family may not leverage financial tool enough. So that's what we teach people. Say, look, we do have financial tool we can leverage for our benefits. Okay? So that's a reason. $1 million, just know a little bit these things, we get 1 million more. Right? And take home message, understand how tax is working. Right? And because tax is for whole life. We've got to deal with tax whole life and know our benefits and be a good citizen. Be a smart one. It's important. We do everything by law, right? So today is about tax, but most important thing, actually tax is part of family financial planning. So we bring money home, we got to save money for emergency fund. And 6 to 12 months living cost saving in the bank. And of course, when we buy a house, how to leverage mortgage strategy. Right? And Maxwell, you have kids, many more on the way.
Yes.
College cost is very expensive.
Yes.
Yes. So that's why, but good thing is, United States are rich. If you prepare well, they go to college, they may get financial aid. I do have friends, his daughter got into University of Pennsylvania, Wharton Business School. Last year got 78,000 free money, financial aid. They just need to pay 14,000. As comparison, his daughter also got into University of Michigan Business School, very good business school. If his daughter got into Michigan, they got to pay 80,000 out of their own pockets. But go to UPenn, only need to pay 14,000. See? Don't worry. We do have solution. Okay? Financial aid is the key. And of course, retirement. Right now, people live longer and longer. Retirement. Because in the United States, retirement is on our own. Right? People used to depend on company we work for or government. No more, right? Have you ever checked your Social Security benefits statement? And you know how much you can get after 67 years old, right? But no guaranteed. If you look at a small fund note, say, hey, without Congress change anything by 2033, Social Security benefit will be discounted. Okay, so we are on our own. How to get this? We teach people how to prepare now. And of course, investment. We want to do investment, right? How to maximize our return, how to control risk. And every decision we make is an investment. Don't you agree? Right? Today you make decision, come here. It is your investment. So you invest 1 hour. Hopefully, 1 hour, listen to my presentation. Hopefully, that will help you. So, and next one, tax. We just talk about tax. And insurance. Insurance is very important in the United States. Without insurance, we cannot survive. Right? But there are different types of insurance. And we teach people which one is good for their family. Long-term care. Because people live longer and longer. The chance we need to have long-term care insurance need is much higher than before, right? How to prepare this? If we don't have good long-term care preparation, it's very likely we may have to dry out our saving to meet the need, right? And estate planning, last but not least, we work hard, we accumulate assets, can we pass to our second generation, third generation? Can we protect it? So that's why we work together with lawyers. So these are the financial need for most families. Do you believe they are very important? Very important, right? So for most middle-class family in the United States, we do have many challenges. First one, we want to do investment. We want to make money work for us, but people may lose money. They get scared of being lose money. Where do they save the money? Bank. So only make bank richer, not us, right? Because interest rate is so limited. Of course, some people get very aggressive. They want to make more, but they may not have knowledge of investment. They may end up lose money. Right? So typical, let's use stock as an example. Typically, when people will buy stock, when stock market going up, right? Your friend tell you, hey, buy stock, it's growing. And when people will sell stock, when they lose money, right? Because they get scared. So people, average investor, always buy high, sell low. That's why they lose the principal, right? This is the challenges, and we pay too much tax. Now, 80% of federal tax is from income tax. Who pay income tax? W-2 earner, middle class family. So that's why we feel we work hard, but still feel like, hey, I feel like I make a lot, but after tax, we don't make too much. Right? So that's why tax planning is very important. And also, college cost is skyrocketing. Right now, if you look at the private school, UPenn, Princeton already passed $90,000 per year. $90,000 per year. If you have little kids, look at us. Easily, when they go to college, easily cross $100,000 per year, remember. So, of course, we want to, as immigrants, of course, we want our children to go to great school, get good education, but we don't want to sacrifice our retirement, right? So that's why, on the other hand, we do have limited resource. Either pay children college or for our retirement. How to solve this challenge, dilemma? We do have a solution. We get financial aid, and so that we don't have to sacrifice everything, and we can have good retirement planning. And another challenge is lack of protection, because I know when we have a house, we buy insurance for the house. We have a car, we got to buy insurance for the car. Some people even buy insurance for the iPhone. But the most valuable item in the family is us, bread earner. We bring money home, money machine. But sometimes people don't even have protection for the money machine. So that's why if anything happens, there will be a disaster to the middle class family. So these are the major challenges for most families. Don't you agree? Right? But interesting, I'm in this industry for about 14 years. What the people do, most people do, they may not help them to solve these challenges. So these are very typical asset allocation. People may have house, but most other non-house assets will be in a red area. Here, we take significant market risk. Whenever we make money, we got to share with IRS. But if we lose money, will IRS pay us? They will know, right? And these are the challenges. Some family may have money in a bank, but how about here? No risk, no tax. Most family, they may not. And this is the challenge. This is the reality for most families in the United States. So that's why we do lots of education seminar. We teach people, let's do reallocation, right? Add 2 more here. But what are the solutions? This is 2 things, 2 financial tools we can leverage for ourselves. Annuity is for retirement. This annuity will provide guaranteed lifetime income we cannot outlive. So that if we have these assets, we know for sure every year, as long as we live, money will come in, so we don't need to worry. The other one is under 7702, these assets, guaranteed, never lose money, and money will grow with the index, and no tax. So by doing this reallocation, we can reduce our tax risk and market risk too, and also we can maximize our tax efficiency. So what is 7702? This is another tool related with tax planning we can use. It is a permanent life insurance protection under section 7702. This one has huge tax benefits and also potential growth. And that's why rich people leverage use this a lot already. But question is how to use it is very important. How does this work? Consider this as our personal investment bank. So every month, we can put money in. Part of it, small piece will go to cost because this cost will bring us protection. If anything happens, at least family financially will be protected. But if nothing happens, we can put more. We can select either 4% interest rate. Remember, this 4% we don't need to pay tax compared to the bank. CD 4% we got to pay tax. Here we don't. And the other side we can go to index strategy. Guarantee with money grow, we don't lose money, and there's a cap there. So the benefits with this one is, no matter how much money we make, zero tax. Will that be good? Right. Remember, we have two tax strategies. One is on the income side, we save tax. The other strategy is on the growth side, we also want to save tax. And this one can help us. And the second one is no risk. We know for sure never lose money. If you know that next year, for example, stock market will going down, but you know you don't lose money. That way, are you willing to invest more? Because when the stock market going down, it will bounce back higher. Because we don't lose money, we'll get a higher return. And no matter how much money you save here, will not impact financial aid. Your children, right? Of course, we need to save money for our children to go to college, but we don't want to jeopardize the chance to get financial aid. This account helps us solve these challenges. We can save a lot, and we can still get financial aid because it's important. This money we can use for retirement. If we don't need to try our fund for the education, we can use for our retirement, for any purpose if you want to. And legal protection, nobody can claim this. No creditors can claim this for our account. And we can use this money second year. Sometimes people feel like, hey, if I save money in this account, I cannot touch it, which is not true. We can take money out anytime if we want to, after second year. Okay. And how to take money out? This is how we teach people. Take money out by loan. There's no tax. If we withdraw, yes, we can withdraw money from here, but if we withdraw, as long as there's a gain, then we got to pay tax. But we don't want to pay tax, right? We take by loan. First 10 years, there's a 0.9% interest rate. But after 10 years, no interest rate. It becomes wash loan. Even we still call it a loan, no interest. But we don't need to pay tax at the same time. Will that be nice? Right? So, and we use money and we take out, we can put it back. The money grow. Tax-free, risk-free. It is like a refuel. I remember 2000, I come to the United States. I went to McDonald's. So you know the drink, free refuel, right? I like it. Same thing like this. You can take it out, use it, and refill back. Yeah. tax-free. You can use this for retirement, or you want to buy a house, it's your account. And give to children, they don't need to pay income tax. And in Delaware, which is good, we don't have estate tax, we don't have inheritance tax. So if we give this to our children in Delaware, 0 tax. That's very nice, isn't it? And cost will be very limited. Those are very good things, but the question is, there are still some catches. There are 2 catches about this plan. One is life insurance first. We got to be healthy enough to get this plan. If we don't get this plan, all the benefits associated with this one, we cannot get it. So early will be better. When we are healthy enough, I encourage people to get it. Second one is, if we want to use this as investment vehicle, it is not short term. We should not do, today we put it in, tomorrow take the money out. Right? Let money grow for 5 to 10 years will be good. So all financial tools, they are always good side. The other ones may not be good side. We try need to maximize good sides, minimize the other side, right? And we can maximize this one. So how can we use this one? These are the major benefits with this account. You can have 11 index to select, and guaranteed never lose money, huge tax benefits, and also protection. We can add a loan care rider. Very good for this policy. But important is, okay, this is my account. I want to share with you. In the last year, 2024 to this year, this is my return. Guaranteed never lose money, and I can get this return that be good. The reason you can see I get 20-some return here is because 2023 actually money going down. But I don't lose money, so when it's come back, I can get this significant return. Right? But of course, past history may not project in the future, but there'll be some relationship. Right? And how to maximize this is very important. That's my function. I will quickly go through, maybe take 5 minutes. Okay, so let's say case 1. For those young adults just get out of college, just have a job, may not save too much. How about just save $500 per month? 1 year, just $6,000. And then after 6 years of working, the income may increase. They can save more, $1,000, right, a month. So total $210,000 in the past 20 years. How much this person can get at age 46? Probably, and how much I can show the number here. After 20 years, if the children go to college, they can take $58,000 for children go to college. And after 65 years old, they can still take this amount for retirement. So this is just an example how can we leverage. As you see here, this is the number, and these are the cash value. This means our investment plus gain, right? And you see at age 45, may grow $290,000 for the assets. And every year can get $58,000 for college cost. But remember, this $298,000 will not impact financial aid. Now, then after college, you have more money and you can put the money back here. And then at age 65, you can still take $58,000 for retirement, tax-free. So until age 90, you may take $1.7 million tax-free money. So this is just an example how can we leverage this tool for our whole life. But of course, some people say, hey, look, when I get older, some people, they say, today I'm already 46 years old. Can we leverage this policy? Yes. We can use this one for college cost, for financial aid. And also, of course, we can design for our retirement too. And so for this case design, the purpose is for short-term to get financial aid as much as possible. So we can use this one for asset reallocation. And long-term, we use this one to build our tax-free, risk-free assets. And these assets can be used for retirement, for asset transfer to children. And also we can add long-term care rider for long-term care need in the future. And let's say people say, hey, I'm 50 plus. Can I use this policy? The answer is yes. But the goal is different. We design this as a tax-free asset accumulation because at a 50 plus, we don't want to take a market risk. We don't want to lose money. Otherwise, if we lose money, it will hurt our retirement. So this one, we focus on tax-free, risk-free asset accumulation and also long-term care preparation and tax-free retirement income. So this tool can be used for any purposes. Seems like iPhone. Still, we still call this as phone, but we don't make phone call. We don't make phone call too much every day. We use this phone for other things, right? Tax, all other things. So 7702, same thing. We can have more, but by design is important. Okay? So this is what I want to provide to you, to the community. I hope the information you get, you can leverage and save tax, have great tax planning. And this is my partner, Yanni, here, and you can take the information. Okay? That's all for today. Thank you for coming. Thank you. Any question?
Yeah, I wanted to ask a question.
Yeah,
Thank you. For instance, I've been doing the taxes for my daughter, who is now 26 years.
Yes.
And then she is a registered nurse. But for like 2 years now, I have noticed, she started nursing like 2 years ago, but I've noticed that she, whenever I try to do her taxes for her, she's not getting much back in returns. And regardless of how much she gets as a registered nurse. So I've been trying to find answers to it. So I asked another tax expert who said that she probably has to think about contributing to
43B?
43B. I don't know whether it's 401k or 403, but she mentioned that think of that or the traditional IRA in order to reduce taxable income.
Yes.
Okay. So how would what's your advice on that?
So your daughter just started career 2 years, right?
Yes, she should have been here. She was here earlier. I wanted her to come back.
So I would believe that right now, the income she makes will be the lowest level compared to the future. Future, she'll make much more. You remember if she make more contribution to 401k, since she's a nurse, I believe that the retirement plan will be 43B. 43B is for non-profit organization. 401k is for profit organization, but the amount is same. So if she want to save tax right now, by make contribution to 43B, maximize 43B, basically she save at a lower tax rate. But in the future, she make more. And then if she take out that 43B out, then she need to make more, pay more tax. Yeah, it's always good to do tax planning. Maybe I can drop by and talk to your daughter, say, hey, based on income, how much she save to 43B, and we can calculate potential tax rate in the future, and she can do some comparison. Yeah.
Sounds good. Thank you.
Yeah, sure.
Yes. I don't know whether it's a tax question or, but in one of the in the presentation there was something about
Oh, mortgage, yes.
Yeah.
Mortgage interest.
Yeah, so I was going to ask, how do you save from taking a HELOC? And, you know, because when you take some of those monies, you have to pay taxes on them.
HELOC, basically you got to pay interest.
Yes, you pay interest, yes.
Yes.
Those interest, you don't get anything back after. It's just like, you know, you give it to the bank.
So if you want to save, I know it's like a mortgage interest can be tax deductible. But if you want to use mortgage tax as deductible item, then you need to go with itemized deduction. But most of people, if they do itemized deduction, the amount of deduction may be less than standard deduction. Because right now, standard deduction, $29,200. Unless your itemized deduction is more than $29,200, yeah, you can go with itemized deduction.
Why?
Because itemized, if most of people, itemized deduction, the deduct amount may not be higher than standard deduction. So what you can deduct, the tax, state tax, property tax together, they're capped at $10,000. Now, natural mortgage interest, you can put it into itemized deduction. And some medical expense, if your medical expense is more than 7.5% of your AGI, that amount, more than 7.5% AGI, that amount can be deducted. But most of the time, people don't have that big medical expense. So that's why majority family, if they go with itemized deduction, the deduct amount is less than standard deduction. So that's why people go with standard deduction. Yeah. Did I answer your question, Nicholas? Yeah.
Just a follow-up.
Yeah, mortgage interest can be deducted, but if you go with itemized deduction, may not be as good as standard deduction.
What Dr. was saying is like we do have to compare both, right? Standard deduction and itemized. Whichever the highest, that's what we're going to go by.
Right.
Yeah.
I see it sounds somehow complicated, but when you have the situation at hand,
Yeah.
that's when it seems more simplified.
That's true. And understand how tax work.
Yes.
Easier.
And I have always had a problem with mortgage, you know, interest that I deduct on my 1040.
Okay.
It looks like, you know, it doesn't matter how much you pay. There's a standard deduction, you know, the point where you can, you know, deduct, you know,
Doesn't change, right?
it doesn't change.
Yeah.
You know, and by April 14th, I'll be scratching my head because I would have paid so much and I'm getting very little. So sometimes it's like, you know, you ask yourself, why go through the trouble of, you know, comparing and wasting your time doing all those comparisons? So sometimes the margins are not that good.
Yeah, so when you file tax return, what deduction you go with? Itemized deduction or standardized deduction?
Yeah, sometimes it depends on, you know, who is doing the tax,
Yeah,
right?
yeah.
I will go to about 5 people to see if I'll get more money. So if I'm paying money and I'm not going to get anything back, chances are I don't want your service. So whatever it is that you have to do for me to get something back, legal or you know, yeah, you have to be smart, right? So that you can get something back. So the whole idea of filing taxes is not because I love Uncle Sam so much. It's because I know I have paid something and I want something back. So that's the idea that, oh, you pay so much and tax return, you got to get something back.
Yeah, so in order for us to save tax, there are majorly 2 things you can do. One, you can save for retirement account. All the contribution go to your retirement account, 401k, 403b, IRA. For me, I have SEP IRA. If I want to save, I can save up to 69,000 based on 2024. But if you don't have business, you can save up to $7,000. 7 versus 69,000. Big difference. So this is one thing you can do. Second thing, you can have your own business. Because if you have business, so many things you can use as business cost can be tax deductible. And this will help you reduce tax on the income side. Now, after tax money, then consider the tool 7702 that put there no more tax going forward. So on the income side, you save tax already. Then after tax money, no more tax. But if you don't do that, let's say some people invest in the stock market. After tax money, go to stock market. Whenever you make, you got to pay tax every year. Save it in the bank. After tax money, save it in the bank. You got to pay tax for the gain. Or some people invest real estate, buy a house, rent it out. As long as you make rental income, you got to pay tax. And you sell it, you make capital gain, you got to pay tax. So that's why leverage two things. Yeah.
No, I just wanted to ask a last question.
Yeah.
We file jointly as a couple.
Yeah.
And there has been suggestions for us. Yeah, I'm talking about a situation where, for instance, your spouse earns, or you earn much, much less than your spouse, based on you don't have too many hours that you do, but you file jointly, all right, your spouse earns more. There have been suggestions to this effect that if you want to benefit much from filing for your taxes, you need to take advantage of what they call the spousal, is it a spousal Roth IRA? I don't know if you're familiar with that.
Yeah.
Contributions. And so I wanted you to just throw some light on that, so that, because it does, I hear it does help if you need to make much benefit from filing.
Yeah. So Pastor, maybe we can have more detail. Okay. So in general, so when two spouses file jointly, right? Maybe one spouse make more, the other make less. So depends on the situation. If the other spouse, for example, may not have 401k or company-sponsored retirement accounts, and then the spouse can make contribution to the individual retirement accounts. So that will help reduce tax. Yeah. But still case by case. Maybe we can, and Isaac, we can drop by your house, Pastor, and we can look at more detail. I can give you some suggestion.
I think my question also goes in the same direction.
Yeah.
But it's a different form as to what is the benefit to file jointly.
Versus separate, right? Yeah. Jointly, filing jointly, right? You can have standard deduction more, and your tax bracket will be higher. If you look at file single or separately, may not be better than file jointly. And you can try if you're single.
Right. In scenarios where, likewise, either of the spouse are earning lesser or whatsoever, just as the example put across, can you verge it to filing separately, looking at the situations?
Yeah. Yes, you can do so. Yeah, you can do so. You can try. If you have software, you can try. Yeah, but.
I'm just wondering, are you doing it yourself or you're?
No, I do it myself.
You do it yourself,
Yes.
right? You're using probably like TurboTax,
Yes, there was
something like that, right? So usually what happens if you already enter your information, the system already calculated for you. They do the comparison. Hey, if it's filing jointly, is it more favorable to you, or if it's filing separately, is more favorable to you? So usually the software already done the homework for you,
Right.
and then they're gonna usually make suggestions to you as like, hey, filing jointly is more favorable to you. But if decided to do that as like, single, like for filing single or separately, then, it's kind of like they usually already done the homework. But if you just out of curiosity and want to do that kind
Right.
of deal, you can do it based like the old days, which is with the paper,
Right,
right?
yeah.
And then the paper, you'll see it that, hey, if I file separately, I need to pay more tax than if I file jointly. But there is some cases in the sense of federal level, because we pay two taxes, right?
Right.
One
State.
federal and one state. So in federal, it might be more favorable for us to filing it jointly, but when we calculating for state, it's more favorable we file separately, okay? So that's why it's kind of like, if you're doing it already based on software, they usually, I'm not gonna say guarantee, okay? I'm just gonna say
Right.
usually, they already done the homework for us, and they're gonna proposing it that, hey, this one is jointly for federal, and for state, it's more favorable if you're doing it separately.
Right. So
Does it-
you can't do them in isolation, just as you said, you file separately for federal and you're going to file joint, you can't do them in isolation, they have to go, if we are doing joint,
No,
both of
No,
them
I
have-
just said it
that's-
for,
that's what-
that's what I
that's
say,
what
she
you
said.
can do it differently.
Yeah.
So
Okay.
federal together, but for
Then
state,
state
you do
can
it
do them
separately.
all right,
Yes,
okay.
yes, it's like, based on my own personal
Yeah.
experience on that.
Same here.
So,
Oh,
yeah.
I see.
Yeah, the system will actually, after you've done the federal, the system will do the joint, the
Right.
state, and recommend that you're
Yeah, you do
better
it.
off
Doing it.
doing it separately.
Separately, exactly, so, yeah.
But I also think that it's also based on the tax bracket, right? So
Yeah.